Steel did report their Q1 numbers. The results were a beat compared to what the street was expecting. The net profits surged nearly 57% on a Q-on-Q basis. The company also invested close to 3,800 crore rupees in capital expenditure and acquired Nilchal Ispat Nigam. We are joined by the TV Narendran, the CEO and MD of Tata Steel. Let's listen into what he has to say.
We summarize the quarter, of course, for us, but is it possible to kind of predict what could happen in the quarters ahead on the back of what's happened in Q1, simply because the world is in such a state of flux?
Yeah. Thanks, Neeraj, for having me on the show. Yes, we are an industry which is always impacted by geopolitical events, so we are never short of excitement, so to speak. So, as far as the trade actions are concerned, we are more impacted by what Trump does with Europe and with the UK, because that's where we sell most of our steel into the US from. We don't sell any steel from India to the US. So we are not impacted directly by the actions that President Trump has announced yesterday. Of course, indirectly, we may get impacted because some of our customers may be exporting their products to the US. But I think it's still a bit early to comment, because obviously the trade discussions are going on, and we'll wait to see what the conclusion is. But yes, we are always planning to maximize sales in the domestic markets, in the geographies that we are in, so that we are less impacted by what happens across the world.
Okay, since we've invoked that, can I just first squeeze in a question on this and then move on to what for Tata Steel specifically, because of the results and then the fundamental outlook.
Sure.
But a broad opinion is that the worst is on the table, which is 25%, and the eventual negotiations will lead to a number which is better. Assuming that that is the hypothesis and the outcome per se, is it, from a business perspective, is it acceptable having a 15% or maybe between a 15 and a 20% tariff rate eventually?
I think that is the new reality we have to live with. I think EU is already realizing that. They had pretty much zero import duty kind of access into the US. That world is behind us, at least as far as the US is concerned. I think increasingly across the world, arising out of this, as well as the geopolitical risks of having a lot of material moving across borders, we are seeing geographies trying to build self-sufficiency, or what we call Atmanirbharta in India, whether it's Europe, whether what's happening in the US just now, what's happening in China. So there's no reason why India should not continue in this direction as we're doing today. So we need to protect ourselves first. Yes, international markets are there to help us scale up. But everyone is taking care of their interests, so we have to take care of ours as well. So I think this is a new reality we have to deal with and find a way around it.
Now, how do you sum up your quarter, sir? I mean, largely in line. I mean, most of the takes that I've gotten say that it's in line to a healthy beat. One of the brokerages also mentioned that. And with the presumption that that's how it's turned out. But because we know that prices, at least one of your peers was telling me that prices in April and May did very well, but June and early part of July was some moderation. So how do you see pricing trends, and thereby what could happen in the near term?
So as far as pricing is concerned, we believe the Q2 realizations for Tata Steel in India will be about 2,000 rupees lower than the Q1 realizations, okay, because of the softness that you just described in June and July. But what is interesting is in the last 1 week, the prices in China have gone up about $40 because of the actions that the Chinese government has announced and is expected to take to manage capacities and unprofitable production. So that is what's happening in India. This is typically a lean quarter because of the monsoons and a dip in the construction activity. But the next quarter is expected to be strong. It's a festival quarter. Monsoons will be over, and it looks like it's a good monsoon. So we will see the continued pickup in the rural markets. So we are quite bullish about the rest of the year. As far as Europe is concerned, the prices will be more flat, will not be showing any drop during this quarter, maybe a slight increase. So going back to the guidance, prices lower in India, flat in Europe, or slightly on the higher side in Europe. Volumes will be much better in Q2 and Q3 and Q4 compared to Q1. So volumes will be on a positive. And most importantly, the cost takeout plans that we had announced are on track. We had said that 11,500 crores of cost takeouts across the geographies. So we are on track for that. The Q1 plan has been pretty much met, and we expect to meet the Q2, Q3, and Q4 plans. So we are basically focusing on what is in our control, which is the volumes and the costs. Prices are not in our control. We will be there to respond to what happens in the market.
Got it. Yeah, in fact, so it's an interesting point that you mentioned, Mr. Narendran, because for most analysts as well who track your business, right, the cost transformation program, the US-EU trade deal, and China steel spreads, which people believe are improving. I would love your thoughts there. But those are the three key catalysts going ahead, aside of all the other factors that you spoke. Now, what weightage do you reckon from a businessman perspective, which of these three or a combination of a couple of them hold the biggest bang for the buck from a business perspective?
I think the biggest impact is, of course, what happens in China. Because, the cost takeout is finite, right? You can take out 11,500 crores, you can take out some more, but it's not infinite. Whereas if you look at steel prices and if you look at the long-term average, the long-term average of steel prices is around $600. We've not seen $600 for a long time, right? So that's largely because China is exporting 100 million tons a year. And so today, I'm talking of international prices. International prices of steel are in the $500, $520 range, right? So there is a lot of potential upside there if China brings more discipline into its production, stops exporting at prices at which they lose money, and distort trade flows. So I think if some actions are taken there, certainly you will see a movement of steel prices towards long-term averages, which will have the most impact amongst the three that you said. The trade actions, I believe, will settle. People will learn to live with it. Some of these impacts are going to be passed on to the customers in the US, because from Europe, they buy steels from us which are not made in the US. So if there is an import duty, they either end up bearing that import duty or at least sharing part of that import duty with us. So that to me is less of an issue. And of course, cost is a very important thing from our point of view, because like I said, that's something we control, we can take action on. So we'll continue to focus on that, but the opportunity there is finite. Yeah.
Okay, and since, I mean, China spreads important, China demand situation important, a lot of people attaching a lot of weight, considering the recent uptick in performance on the European side of your business, to what your commentary is like for Q2 and H2 on the European side of the business. Maybe you spoke about it very briefly. Could you elaborate a bit on that? How do you see that picture for the next 9 months?
So, we had a tough year in Netherlands about 2 years back. And since then, we've been on a recovery mode. Netherlands, if you look at it, has traditionally been a EBITDA positive, cash positive business, right? And it will continue to be that way. So this year, Q1 is positive, cash positive, EBITDA positive, Q2, Q3, and Q4 will also continue in that line. So we are less concerned about Netherlands from a profitability point of view. There are issues there we are dealing with, and there are these cost takeout actions we will do. UK has traditionally been the problem child for us. A lot of effort has been put in over the last decade or so, but I think we are coming closer and closer to an era where the UK can take care of itself. It can be EBITDA and cash positive. We are not yet there. As you can see, the EBITDA, negative EBITDA, which used to be in the range of maybe 300 to 500 million pounds negative EBITDA per year. Last quarter was 40, the quarter before, or rather this quarter was, Q1 was 40, Q4 was 80 million negative EBITDA. So we're seeing that we're moving in the right direction, and we certainly expect to be EBITDA positive by the end of the year in UK. So once we do that, then the European business is pretty much taking care of itself. And that's a direction we are moving towards, and this is despite very difficult market conditions. So these are not good times by any stretch of imagination as far as markets are concerned. And if we are able to be EBITDA positive in these difficult times, that augurs well for us for the future.
I can imagine. My final question, Mr. Narendran, and amidst such volatility, because if US suddenly, after making the market ready for whatever they had spoken about copper for all this while, suddenly excludes copper from that list and the prices plunge, then how difficult must it be to run the metals business is anybody's guess, really. But thankfully, I'm not in your shoes. But just one question on the input costs as well, Mr. Narendra. How do you see those shaping up? Is it possible to kind of take a 6-month, 9-month view there, or are you playing it by the day, if you will?
So if you look at coking coal, which is for us the most important input, both in Europe and in India, we expect this quarter consumption to be about $10 lower than Q1. Q1 was about $10, $15 lower than Q4. So that trend continues. Coking coal prices have stayed in the 170 to 190, $195 range, which is good for us. It's a big part of our cost, 25 to 35% of our costs. That market is not very liquid, but China, who's a big consumer of coking coal, has diversified beyond Australia, who's a major supplier for us in India. And hence the coking coal prices have stayed where they are. So we are expecting it to be in that range, maybe touching 200 at some point in time, but not shooting up to the $250, $300 that we've seen in the past. As far as iron ore is concerned, there's more liquidity in the market. Doesn't impact us directly in India. Has an impact on our costs, particularly in Netherlands. In UK, we've stopped the blast furnaces, so we don't depend on iron ore prices. Iron ore prices are more range bound in the 85 to 100, $105 range because there's a lot of new supply coming in Western Africa. The Simandou mine is expected to produce about 100 million tons over the next few years. So that's a new mine which is being commissioned now, ramping up. So iron ore will be range bound in the 80 to $105 range, and we expect it to stay that way.